Welcome to the Invexora podcast series, where we decode the world of investing with India's most trusted financial minds. I'm your host Gaurav Mahajan, and today I'm absolutely thrilled to have Mr. Jay Sir, founder of SH Wealth, with us. He is a SEBI registered investment advisor with years of experience helping retail investors navigate through the complexities of the Indian markets. So, Mr. Jay Sir, welcome to the show.
Thanks a lot, Gaurav. Thanks a lot for inviting me to this podcast.
Yeah. So before we dive deep, could you briefly tell our listeners about your journey and what drives your approach to the investment advisory?
Okay, great. So just to introduce myself, I'm Jay Sheth. Currently, I am a SEBI registered investment advisor, and I operate typically on the fee-only model as of now. Okay, wherein we just charge fees to advisors, and we are not really earning anything out of product sales or commissions. Okay, and so more on my background. So I've done chartered accountancy through ACCA in UK, and I've also done an MBA in finance from US. And after that, I have worked for a few years in US, then returned back to India, and here I was working for the Big Four with KPMG and Deloitte in management consulting. And after more than a decade of professional experience, I started off my own and had a family business into electronics and e-commerce. And post that, I really decided to then dive into personal finance, which was like always my passion as far as personal investing goes. And then that's when I really became a investment advisor and started Shwell, right? And as I said, here we work on the core principles of being very ethical, transparent, and providing a research-based, very tailor-made, customized plan for our clients.
Yeah, right. So perfect. So let's start with the big picture. How
Sure,
would
sure.
you describe the state of the Indian stock market in 2025? And more precisely, for our listeners, are there any sectors or themes that you feel are currently undervalued or maybe overhyped?
So see, if we talk about 2025, right? So we kind of entered 2025 itself on like a negative note, correct? Since October to December,
A
the
lot of things
broad-based
have happened.
Sensex Nifty was already down by 7-8%, right? And so 2025 we entered with a lot of volatility and not knowing what to expect, and the kind of downfall continued, and we saw again Nifty Sensex falling by another 5 to 7%, and overall mid cap, small caps, they fell, I think, even more than the Nifty 50. So when Nifty 50 fell like around 15% in 6 months, mid cap, small caps were like around 22-25%, right? And then in kind of April, I think for 3-4 weeks we had a strong pullback and the markets came up, right? But again, after that, it's been very flattish and very sideways movement. Every 2-3 days of gains are kind of then wiped out in the next 1 or 2 days. Okay, and the reason I think has really been that one is FII has been constantly pulling out money because they've kind of found better avenues, better markets like China, Brazil, where they feel there'll be more short-term gains right now.
Right.
Correct. And also to continue, I mean, not all results have been very encouraging. Quarterly results from companies, right? So that's also kind of a reason why market has been sideways. And thankfully, what has given a lot of support to the market is the domestic SIPs that are kind of on record highs. Otherwise, we would have seen maybe a much higher fall in the markets,
Right.
right? So again, I mean, see, going forward, I think this domestic investment is probably going to continue, right?
Right.
And so until there are strong results and everything, that's when we can probably see a more positive moment. But as of now, it still very much looks like a sideways movement for some time.
Can we see more corrections or is it going for bullish?
See, again, as I said, I think it should be a bit sideways, right, for a few months. And Again, what we really need is a lot of good positive results from companies, right? And again, I mean, if the other markets kind of underperform and FIIs come back, that could be probably the next, growth of phase of growth for us.
That's a fascinating perspective on the current market dynamics.
Thanks.
Speaking of market conditions, I'm sure like many of our listeners are wondering like what advice would you give someone in their early 20s who's just starting their investment journey, especially in today's world where information is everywhere, but so is the noise.
Right, right. Very, very good point here, Gaurav. So, when you're starting off, as you said, there'll be a lot of noise around, correct, on investments, and people kind of try, do a lot of research and kind of jump onto the trends and everything, right? But for, as you mentioned, a young investor, right? So what I'll say is, investing is just a part of a larger, you can say, financial plan, right? So investing kind of actually really comes at the end of it, right? And right, investments is kind of going to be a means to achieve your goals and say your financial independence. Surely. But to reach there, first, a lot of things have to be in place before you start investing. So, if you talk about typically a financial plan, and that's what I would advise young people to kind of, stick to a very basic financial plan, stick to the basics as of now, not try and, when all this information get lost and keep it very simple. And so, like your plan would kind of just begin simply with first taking
Basic.
care of your insurances. And when we talk about insurances, it's both term insurance and health insurance. Okay. So if you have any dependents on you, maybe your parents, and if probably you're married by now already, then your wife, your kids, right? So whoever is dependent on your income, you really need to get a like a plain vanilla term insurance policy to protect them, right? Because again, you are investing to probably not just for your future but their future also.
Right.
So it's very important that you kind of secure them first,
Mhm.
because no amount of investments in the next 2 5 years is going to protect them. You're not going to build that kind of a corpus for your loved ones.
Mhm. Right.
Next, very critical is comes as your health insurance. So even if you have like your company health policy,
Mhm.
right? Still, it's very critical to have your own private policy
Right.
for you and your family. And the simple reason being that if something like major happens, major ailment or disease, a lot of insurance companies would never give you your own insurance, right? So if you leave your job, say in future you go into a business, or say even retire early or whenever you retire, right, you'll be left with without health insurance, and I mean that could really wipe out a lot of your savings,
Savings.
right? So that's something very critical. Post that, what you need to do is create like an emergency fund for yourself, at least 3 to 6 months of your expenses into probably a liquid fund or a fixed deposit. Post that, do a tax planning. Okay, that's also very critical. So a lot of people, by the end of the year, they try and figure out what do I do on taxes,
Mhm.
right? So that's really not the right strategy. You need to kind of do it upfront so that you can probably save some money on taxes if you can. And then after that, you need to do your budgeting again. Extremely critical. Okay, so kind of, as probably Warren Buffett says that first you kind of save and then spend what is remaining, right? So hence, any young person should really aim to kind of at least save minimum 20% of their
Income.
income. So that is the minimum required. If you keep saving 20%, then probably by the end of 25 30 years you will build a
Mhm.
corpus for
Corpus. Yeah.
yourself to retire. Anything less than that, I mean, you are not going to build your corpus, right? So hence it's critical for you to make a budget for yourself and kind of follow it up and kind of review it regularly.
Right.
Post that, then you can identify your short term and long term goals, correct, financial goals, what they are. And after that, you come to the investments, that now based on this, which are the instruments available to invest, which can really get me to these goals, right? So that is the kind of advice I really would give to any young investors out there, to probably follow a plan and not just jump into
Investing.
investing.
And actually, a lot of youngsters are like neglecting these topics, and a lot of people are directly jumping into the options trading. So, like you've touched on like something really important, and that actually leads me to something that's creating a lot of confusion among beginners, like the whole trading versus investing debate. Like there is so much buzz around both approaches. Like how should a beginner actually decide which path to choose after all these aspects? And do you think a mix of both is preferable?
So, look, I think trading and investing both are really very separate things. Okay, I would say. So, a lot of people confuse themselves by thinking that trading is a part of investing. Okay, which I really personally don't feel is true at all. Because trading is more like a short term or a business activity, as I would say, whereas investments is like more of a long term activity, right? That anyone and everyone should engage into, correct? So again, trading, I'll say it's like a business in itself. Okay, so to do business, you really need to kind of understand that business, have the particular skill set. Just because you understand does not mean you have the skill set, right? And it requires, any business requires time and effort, right, to kind of master it.
Right.
And if you talk about trading, I think it's a very tough thing to master. Okay, to be very honest. Now, see, I am like a Bombay guy throughout. Okay, I stay very close to BSC. Okay, which is the home of trading, right? If you look about 20, 30 years back, this was actually the place to be in if you wanted to be trading, right? And also, I come from a Gujarati family. Okay, so there are so many people in family, extended family, who were traders, and the important by point being they were traders. Okay, so someone was doing it for 2 years, 5 years, 10 years, 15 years, but I think hardly there is anyone who sustained himself in this, and that to someone who's doing it full time, correct? Who's in the market all the time, having tons of information, and still they've struggled to make a consistent living out of it. So, I mean, for any young guy, I mean, rather than wasting your time and efforts in doing this particular thing, it's much better to focus, on whatever your job is,
Right.
or maybe develop some other skills. And for your, financial gains and everything, it's just better to go through the investment route. Though, I mean, it will take time to kind of make gains in that,
Compound, yeah.
make profits, make a large enough corpus, but it's kind of a short way to get somewhere, right? I mean, trading short term, you may make some money here and there, but long term, you just don't know where you are going to get.
Long term is the only sustainable option, right?
Correct.
So that's such a balanced way to look at it. Since we are talking about like beginners, right? I'm curious about the mistakes you have seen from your extensive experience from working with retail investors. What are the most common mistakes you see investors make? And more importantly, how can they avoid this?
So see, as I think we earlier touched upon, was that complete plan needs to be followed, correct? With the aspects related to insurance, tax, budgeting, asset allocation, goals, right? So not following any of these, it's again a kind of a mistake or a pitfall that we can talk about. Like for example, not having health insurance is just like biting people so much. Correct. Like I have couple of clients who are say less than 30 years old. One is 28, one is 29, and they got like a brain tumor at that age, right? So I mean, thinking that these things will not happen to you, you have time. It's not really true, right? You kind of need to follow the principles across. Okay, and other than that, other than these things, the mistakes that most people avoid make is one is going for tips, right? Everyone loves the story of someone making 2x, 3x, 4x in 4 months,
Right.
and they think that they've got this tip from this guy and they should also invest. So I think again that can be really avoided.
Right.
Second thing is just because someone worked or something worked for someone, some strategy, right? Doesn't mean it will really work for
Work
you.
for you.
Okay, maybe that guy is really smart. He has had his things sorted out, but he's made some investments and maybe bought a policy for his own needs. Your situation would be very different, right? So just don't kind of blindly copy somebody over their situation and accordingly take a call. Other than this, again, a big mistake that a lot of beginners kind of make is they really want to own a house very soon.
Right.
Correct. And especially, if you're in Bombay or some metro where real estate is extremely expensive.
Expensive, right.
Correct. So what happens is most of your money just goes totally into real estate.
Hmm.
Okay. And so all of your salaries is going into your expenses or the EMI, right?
Right.
So what happens is two things. One is, of course, the real estate doesn't give you returns, but fine, that is for your own living purpose. So we probably can not look at the returns part.
Like
But
peace
the
of
second,
mind.
correct. But the second thing, what happens is you don't get any investing experience, correct? Because all your salary is going into the EMI. You don't have any investing experience. Plus, the real, magic of compounding is missed. If you miss your first 5-10 years of investing and all the money just goes into real estate, you lost a lot of time in that also, right? So I think those are the things that can wait, right? Just wait for the right moment
Mhm.
to kind of invest in real estate. Once you've made some corpus for yourself, you've got some experience, your salary is probably better, then maybe you can evaluate having your own real estate.
Yeah. So those are some really valuable warnings right there. Now let's get practical for a moment. Once someone avoided all these pitfalls and is ready to build seriously, what would an ideal portfolio actually look like for a investor with a 10 to 15-year horizon, and how often should they rebalance or let's say restructure their portfolio?
So are you talking about an overall kind of an asset allocation
Yeah, yeah,
here
like
or just
mutual fund,
equity portfolio?
ETFs. Yeah, yeah, equity and all.
Overall portfolio you're saying.
Yes, overall.
So see, again, every young guy is different. I mean, every person is different in their situation. Okay, so we cannot have like a same picture across everybody, every individual. Okay, so if you look at the classic texts or whatever, a lot of formulas, they kind of tell you 100 minus your age is what you should probably put in equities. So if you say you're talking about a 25-year-old guy, for example, it means about 75% in equity.
Mhm.
Okay, and yeah, that's a fair assumption, 65 to 75% for a guy with a 10-15 year horizon. Okay, sounds great. The situation may warrant really something else.
Mhm.
Okay, just give you a simple example. If there are two guys working in the same office with the same pay scale, right? And say one guy is living at home with his parents, okay, and he comes from a good affluent family where maybe 2-3 years down the line he's going to get married and most of the marriage expense is going to be borne by the family, and at the same time he has a colleague, right, who really comes from a tier 2 tier 3 city. He's staying on rent and whatever future marriage expenses or everything in 2-3 years he'll have to bear.
You have to.
So the situation is so different, correct? And so what happens is typically the second guy he'll really need to kind of first have an emergency fund, a much bigger emergency fund than the other guy, because the
Exactly.
other guy is kind of protected by his family also,
From his family.
right? So that is why his debt component automatically increases because he has to go for emergency
He
funds.
has to start from the scratch.
Correct, right? And also, if you then look at in 2-3 years, see if he has a goal of say getting married, right, for which he needs money. So of course, that money he cannot really put it in equities. So again, that he'll have to maybe take a debt exposure for that also, right? And again, understand his savings also may be very minuscule compared to the other guy because he's staying on rent, meeting all his household expenditure. So in his case, it may happen that because his goals are such, right, he may actually not be able to get anywhere close to the 65%, right?
Right.
He may be much lower than that.
exactly.
And also at that age, what you have to understand is, because they may not have a lot of capital itself. So for example, someone has only 5 lakhs of capital. Now 30%, if you say put it in debt, that comes to only 1.5 lakhs. So now again, is 1.5 lakhs sufficient for you for any kind of emergencies or anything that you may have, right? Because it's not about percentages, it's about absolute amount also then,
Right.
right? When the amount is small, right? So those are the few things that a person needs to look at. Or otherwise, if I were to make a blanket statement, of course a 10-15 year horizon, everything is say sorted out, then of course, yeah, you can go anywhere between 65 to 75% in equity and keep others in debt. And within equities also, again, I think if you're just starting off, kind of it's better to go for say index funds and large cap funds,
Yeah.
because they kind of come with lower volatility,
Volatility.
right? And so when you're starting off, you don't want the first for 1 2 3 years where you are seeing kind of negative returns, right? Because that sort of kind of puts off a lot of investors,
Mm-hmm.
and they may just stop investing also. A
Mm-hmm.
lot of them, that's what happens when they get negative returns. They'll be like, this is no longer good, right? Let me explore something else, correct?
But
So that is
you
why
have
it's
to
important,
stay consistent.
correct. So it's important you basically go for these instruments which are low volatility, rather than just going for returns, correct? Yeah, so that's another pitfall, if from the last question, that again, youngsters should not just fall for high returns.
Right.
It's just not worth it, and it's better to kind of tailor it to your own needs, correct? And once you kind of gain your experience in investing, you have a bigger corpus, then you can probably think of taking the larger risks for the larger returns
Yes.
that you would like.
So that
And I
is.
think also you asked about rebalancing,
Mhm.
correct?
Yeah, yeah.
So see, I think whenever you're investing, probably at least once in a year, at least you need to take stock of all your investments,
Mm-hmm.
where they are, right? And that is the time maybe you can think about rebalancing. If your situation has changed, or say one asset class has done very well and it's become very heavy in your portfolio. Those are the times then you can probably think of rebalancing.
So that portfolio framework makes a lot sense. And I have to ask about something that's been a cornerstone strategy for many individuals for a while, which is systematic investment plans. In today's volatile world, do you still believe SIPs remain a reliable wealth building strategy? And what's your take on this?
Okay. So, again, two parts of the question. I think one is SIPs and volatility, and second part being, I think, whether they are good enough for wealth building. Correct. So see, SIPs especially are meant for volatility. Correct. That when the markets are down, you kind of ride the wave and enter into the lows. Correct. And which also means you'll be getting inside the highs also. But again, when you are getting in the investing when the markets is high, that is also a time when you are seeing good returns on your portfolio. So typically, like the way a mentality works is, unfortunately, that people are more pro investing when the markets are up. When they see good profits, nobody actually minds putting in extra money at that time. Where you fear the most is when the markets have gone down. That is the time you kind of start questioning things, whether I should continue investing or not. Right. And that is the time when you have your SIP going on, you will automatically be investing during that particular time.
Right.
And now, as the second part of the question, as you asked about, are they good for wealth building? Okay. So now see, if you want to build wealth through investing, a very beginner retail investor, if we talk about the options you would have, are basically you can go into debt. Now, debt is never going to build wealth for you. Okay. It just after tax gives you probably 1 or 2%
Yeah.
above inflation. That is if, right, a lot of times even that would not happen.
Mm-hmm.
Okay, so now debt is not going to build it for you. Real estate, again, as I said, is not a great story. I mean, yeah, people think in their minds real estate makes money because what they compare is that someone bought a plot over here or a flat over here for 10 lakhs, and in a few years it became like 50 lakhs. So great wealth. But when you peel it down and look at the CAGR, it's not that high.
Yeah, right.
And on top of it, there are a lot of costs associated in terms of property taxes and everything, which are then never factored in those calculations. That's just a top of your head thinking that you made money, right? And typically, people that have made real money in real estate are ones who kind of really invest at the project level, when the project is not out in the open for retail investors, and they really invest at a very cheap price. Those are the ones that have really made some money out of it, right? Then your other options are again like commodities like gold, silver, which again, I mean, people can have very limited exposure to that. Nobody is going to put majority of their money there. So which kind of leaves you with equity. So now equity also, there are just two options. One, either you directly invest on your own,
Right.
correct, directly into stocks. So yeah, you can do that if you are experienced enough, or you can research a particular sector or an industry and can really find out winners, right? Then yeah, a retail investor can do that. Okay, but I mean, it's not going to be everybody's cup of tea, correct, to find those winners out there.
Yeah.
Right? And so the much better way to do it is through mutual funds,
Mutual.
correct, that they have the kind of expertise, the bandwidth, the research to do that for you, right? And also, as I said, I mean, index is a very simple way to invest and kind of grow with the markets.
Right.
So definitely, I mean, SIP in the equity market is a way to build wealth for a beginner.
So I love how you've broken that down. But Jay, here's something that really concerns me about young investors today, particularly with so many influencers and self-proclaimed experts offering financial guidance online. And I mean everywhere from Instagram to YouTube to other social media. How can a young investor separate a genuine mentorship from complete misinformation from this? And this was one of the reason we made Invexora. Yeah. So how
So
can
great initiative by you all
yeah,
to do this, and I think a wonderful question. And see, this is a struggle not just I think in the world of finance, but I think in all areas of life. If you look at right from services to products that we want, this is a problem that social media is filled with too many people giving too much information,
exactly.
right? So like, I mean, I remember typically 5 6 7 years ago, or still we do that, right? The first option is Google it, right? If you want something, let's ask Google. And
Exactly.
now even you can add ChatGPT to do that,
Exactly.
right? To kind of guide us.
Mm-hmm.
So before, there were not so many influencers out there, right? And you kind of really trusted what people were saying, right?
Exactly.
Now it's just all become a lot about endorsements. The guys previously who were like so good. Okay, I'm not talking about finance, but in overall, right? That you used to follow because they were genuinely giving information. Now you see again they're endorsing products. So now kind of you no longer follow them, right? So everyone is now again looking at now where do we go to, right? Where do we trust, correct? So now if we talk about the finance world, I think one very good filter over here, okay, is that SEBI has come out with a regulation that you need to be certified to give investment advice.
Advice. Yes.
Okay, because they are very very aware of influencers, right, as they call it. Okay, who a lot of them don't have the educational background or the
Exactly.
experience, correct? All they are great at is marketing,
Exactly.
correct, and just bringing in the viewers, correct. So this is, I think, a kind of a first filter that any young investor can really put to see whether this guy does have the qualifications or not. And once you're SEBI registered, you know that this guy is operating under the law.
Exactly.
He has the necessary education qualifications, and he has the necessary experience to give this particular advice. Okay, not to say all influencers are bad. A lot of them are good also. They give good advice also. But
Right.
the point is to differentiate it. It's very tough. And that is why SEBI is asking every all these guys also to come under its umbrella. If you want to just provide genuine advice, come under my umbrella and operate under these rules.
Hmm.
So, I mean, any guy you needs to ask that, then why is this guy not getting himself registered
Right.
if he wants to carry on this business? So that is the kind of the first filter you can provide. And the second one, I think, what beginner kind of needs to look at is that what is the business model of this particular advisor.
Right.
Now, as I said, I am a fee
You
only
only.
model. Okay. So again, it's a very unbiased model, right? Where we are working for the client. Okay. Because it's whenever you are working on commissions, it's very tempting to kind of recommend something that is going to earn you more commissions, right? So kind of it's better for beginner to understand this and choose the model that he wants to go with. Correct. It's much better. And finally, I mean, if he wants a real advisor, genuine mentorship, right, then he kind of needs to first assess what is it that he really wants out of a advisor, right, and then kind of look at what the advisor is offering.
Hmm.
Okay, so again, in that, there could be that you just want someone who tells you do XYZ, 5-10 bullet points. Or maybe you could be someone who just doesn't want that advice, but also some guidance, some recommendation, some more options, discussions of why X, why not Y, correct? So I think it's important for you to determine your own needs and see what advisor can offer you.
Hmm.
Discuss it with him before kind of taking on that person as an advisor, and kind of see if your views are matching, and finally your wavelengths should match, right? I mean, that's most important in any transaction
Right.
between two people.
Yeah. So in all these pain points where Invexora comes in place, like all our mentors are like you can see the education details, you can see the qualification, you can see what the mentor is offering, what are the services, what are the pricing for the services. So like everything is transparent, and that's one of our USP.
Yeah, that's great. I think that's the need of the hour for any
Yeah.
particular investor.
Right. So yeah, let's wrap this up now. I guess we have
Okay.
covered a lot of topics.
Okay, great, Gaurav. Thanks a lot for this opportunity over here. Really enjoyed this podcast. Yeah.
so
So
I want to
I.
leave our listeners with something actionable. If
Mhm.
you want to connect one-on-one with Jai sir, sign up on invexora.com and book a session with a preferred slot. So thank you for joining this podcast.
Great, great.
See you
Thanks a
in
lot,
the next
Gaurav. It
one.
was a pleasure.
Yeah.
Yeah.
Thank you.
All right. Bye bye.
Yeah. Bye.